Jonathan Schiessl then on the show with us. Jonathan, hi, afternoon. Just wondering as to how short-lived all those measures announced by the finance minister as recent as Friday evening were. Doesn't seem like the market is too enthused by the FPI surcharge going, a lot of SOPs coming in for the beleaguered auto as well as a PSU bank recapitalization as well.
Yeah, well, we've certainly had some, better news over the last week, but obviously markets have been in a downtrend for quite some time. And the reality is, I guess people want to know with the RBI surplus that's just been transferred, what is the government going to do exactly with that surplus? But I guess the reality is it's going to take time. It's a confidence issue, I think, mainly, and that is going to take time to resolve.
Well, what's the worst we could see in the near term, Jonathan, given that the global dynamics are not looking all that constructive right now? Despite any kind of near-term relief, the overall mood still continues to be incredibly cautious.
Yeah, I mean, clearly, with what's going on with the continued uncertainty with the US and China trade talks or lack of talks, oil, obviously, there's still a lot of uncertainty in the Middle East going on. So the global backdrop, US interest rates, et cetera, is not helpful. I've said before, I do believe emerging markets in general are quite well positioned this time around compared to prior periods of slowdown. But clearly, in risk-off events, we had seen quite a bit of foreign money coming into India just prior to the election. I think there was a bit of profit taking, so some of that is reversed back out. And it's interesting to see if you look at foreign holdings in certain categories, we're at levels we haven't seen since 2012. So foreigners have they put a little bit of money in just before the election. And then I think all they hear now is clearly, the slowdown, consumption slowdown, what's going on in the auto sector. And so it's not good news that we're hearing from the outside, and people are just, with a risk-averse nature, they're pulling back.
Oh, yes, indeed. And speaking of the auto sector, one that has been beleaguered for quite some time, we have the corporate voices within the space as well, acknowledging that slowdown and taking, quite a few measures in order to try and stay afloat. There were measures as well announced by the finance minister. Do you think that has done enough, or is there a lot more that needs to be done to actually change the fortunes or turn the tide when it comes to autos?
Yeah, I think it's a step in the right direction, but clearly there's been so much pain that's been felt, and clearly financing is still a huge issue around that space. So I think it's like with everything else, a lot of people are looking, obviously coming up to the festive season, to see what's going to happen there. I think people are just looking for some, good news, and sentiment can change pretty quickly. But I think, the reality is this will probably take some time to work through. It's obviously been quite a brutal slowdown, particularly in the auto space. And, you don't recover that quickly without, perhaps more stimulus from the government, which you could argue scrappage policy, all sorts of other policies, which I think the street was hoping for. There could be more to be done, but with the fiscal side, there's always an issue there. And, there's plenty of other sectors which are also suffering to some extent. So I think, for me, it's really a confidence thing. And if we can get a bit of confidence back, a little bit of decent data coming out, one or two data points, then that could change.
Sure. What would you like to hear then, Jonathan, from the government? Because from their end, they're doing whatever they can with the limited elbow room that they have on the fisc.
No, I think that's a very good point. I think the reality is, certainly from looking from the outside, I think if investors saw suddenly the fiscal deficit, exploding out of control, that would obviously have terrible ramifications for the rupee and yields, etc. So I think the government is in a constrained space. I think they are trying to do as much as they can. And that's why I say, if they can do, they're obviously doing as much as they can, as I said, but it's a confidence issue. And once confidence and sentiment stabilizes and turns, I think, that's the key. And unfortunately, that'll probably take a little bit of time. This is not going to be, I think, in reality, a very quick rebound when it comes. It's going to be probably quite a slow rebound. And for the auto space, which has been through so much pain, it's probably going to, what we need to see is some stability, because obviously the data points have just been sinking over the last few months.
Jonathan, the kind of foreign flows as well that we've seen into Indian equities, they've declined quite sharply of late. Do you think that we're likely to see the overall liquidity situation pick up anytime soon, or do you believe that, foreign investors will continue to remain on the fence and sell off?
Yeah, so that comes back to the bigger picture about what's going on with the US. Obviously, what the bond yields in the US, the dollar, that's all very important. My view would be, I'm not, obviously the world and investors are concerned about this, further data points showing the economy slowing down, the global economy. And obviously at the heart of that is the issues over the US and Chinese trade. So if we get some stability from there, which I guess the street is beginning to think we won't, but if we were to get some stability from a trade perspective and global growth just stabilizes a bit, then I think foreign investors would probably look again at where they're willing to take risk. And as I said previously, emerging markets do look quite good. They have come off. And if you look at the fiscal imbalances and the other macro indicators compared to prior crises, I think emerging markets do have firepower, if you will, in the event of a global slowdown. So there is plenty of room to cut interest rates in the emerging world, and the fiscal deficits aren't as bad. And India certainly stacks up quite well on some of these measures. So, real rates can still come down in India. Obviously, there's been a transmission issue, which hopefully is being addressed as well. So there is scope to stimulate the economy.
So as an equity investor, Jonathan, what's the right approach right now? Do you go at all close to the beaten down mid and small caps, because that's where valuations are looking most ripe, anticipating and hoping for a recovery in certain pockets? Or would you completely steer clear of equities, just stay put and see where your large cap holdings go?
Yeah, so we've continued to maintain a balance. Yes, we have more exposure to larger cap stocks than we have had for a number of years, and we're not looking to readdress that anytime soon. That said, one or two individual counters in the mid and small cap space, when they're getting to valuation points, which we've been looking at for some time, then we are selectively looking at some names. But I think as a whole, with the risk that we have still at the moment, it's probably not quite right to go jumping into mid and small caps. Yes, there's good valuation, you could argue, at an index level, but history tells you it could sort of head a bit lower from here. That said, if you find a good quality stock, you're comfortable with the valuation point, and you do believe it's got a good runway for growth, then it's no harm beginning to sort of nibble around the fringes on some of these counters.
Okay, would you like to just, elaborate a little bit more within the mid caps? Which are the areas or which are the sectors in which you're seeing a bit of comfort?
Yeah, it's difficult to say, because obviously the mid cap space is more down to individual stocks as opposed to sectors. The areas we've tended to focus on, certainly for the last few months, have been, if you like, more growth orientated areas. So the financials is an area that we still do like. As is it in some of the industrial space, very selectively. But there is a lot of pain points at a sector level, but it comes down to individual stocks. So yeah, it's probably won't elaborate on names, but you just have to do your bottom up work on each name.
Okay, fair enough. There might be, again, some measures that are announced by the government. We were talking about some FDI reforms. May also see some other moves that could perhaps try and stimulate things in the near term. But Jonathan, realistically, what's the kind of timeline you're looking at before we actually see earnings growth pick up?
I mean, earnings growth, we've been waiting over 8 years for that to start picking up on a sustainable basis. I think the reality of the data we're getting out on growth is it's going to be a few more difficult quarters yet. Obviously, the financial sector has been doing the heavy lifting over the last 1 or 2 quarters. Obviously, that'll start easing off. So we do need to see a broadening out of a recovery. And consumption clearly is going to be the important part to sort of click in. The consumption sector, or the sectors that are focused on consumers, if you like, went through quite a lot of pain in the last quarter. We've probably got another 1 or 2 quarters of pain there. But certainly, if you do see an improvement in sentiment, then probably the consumption space will be the first space to sort of see a recovery there. So that area is an interesting one. But on a broader basis, when we would expect a recovery, we had been saying in a couple of quarters' time, but obviously, as you rightly say, we've got potentially more stimulus measures to be announced, which we'll have to see. But certainly, I think a fully fledged earnings recovery is still a little bit distant away.
Okay, but in anticipation of a recovery, whenever, Jonathan, into staples at least, because some of these growth stocks are looking fairly attractive, they're close to their 52-week lows and some signs of a recovery really coming in. Would you not start nibbling in already into any of these names?
Yeah, I guess the issue with a lot of the sort of core staples names is the valuations. When you look at the valuations of that sector, and of course, up until recently, it had been viewed as a good hiding place. But the trouble is, your starting point was excessively high valuation points. So we haven't really seen, to my mind, a significant sell-off in that space, because I think the risk aversion generally has kept investors in some of those stocks. I'm thinking more of the consumer staples names, the Hindustan Unilever, et cetera, et cetera. So some of those names have stayed expensive. But I guess some of the mid and smaller cap names in that space have seen quite a bit of derating. So they are getting a little bit interesting.
Any thoughts then, Jonathan, as to where crude oil prices, and what the trajectory could really be in light of all of these global recession fears that are looming large?
Yeah, I mean, obviously with a global slowdown, you'd think oil would react on that basis. I believe there was some data showing US inventories were slightly less than expected. So that's obviously caused a bit of a spike in crude very recently. But the reality is if the global economy is slowing down and unless OPEC reacts to that, then crude prices you would anticipate would react to underlying fundamentals, unless, of course, we get a massive cut from OPEC. So crude, clearly can help India. I think it's not much talked about point. The positive side of crude coming off for Indian growth and for the Indian macros. But obviously, we need to see that coming off a bit more substantially than where the crude price is currently. Okay,
and given the way we've seen the dollar as well move vis-a-vis some of the emerging market currencies, do you believe that this kind of a trend is here to stay for the dollar?
Yeah, it's a difficult one. I guess it's all about relative growth in the global economy. And I think if you look at the moment with a strong dollar, that's indicating the market is believing that growth looks compared to in the US compared to other countries looks better, and therefore the dollar's been quite strong. Obviously, if the dollar comes off and this global recession isn't quite as bad as everybody's anticipating, and the slowdown in China, we see more stimulus in China potentially, and some emerging markets with this greater flexibility that they have this time round, if they do start actually putting measures in place, and relatively speaking, growth suddenly looks better outside of the US than in, then you'd expect the dollar to weaken off a little bit. But at the moment, with the risk aversion and with, I guess, the street believing US growth looks probably better than anywhere else in the globe, the dollar looks quite well bid for the time being.
So finally, Jonathan, in comparison to the rest of the emerging markets, just give us a sense as to where India stands.
So, as previously said, so foreign investors have been pulling money and continue to pull money out of India. I think there is some concern, and it remains, about what's happening with China. Clearly, on the trade side, news out every day, you see MNCs pulling out of China and relocating elsewhere, which actually is quite, that's quite good news for India. There will be some spill-off effect to India from that. So I think the China side, is still quite a cautious sort of story. But the reality is it's such a huge part of the benchmark that investors have to be there one way or the other. But compared to other markets, I think India actually remains quite well positioned. Obviously, India is primarily a domestic story, not such an export story. So when you consider that and you consider the underlying fundamentals in India, it is quite well positioned as it stands today. But obviously, the biggest hindrance remains global risk aversion, to my mind.
Thanks so much for joining us, Jonathan. Good chatting with you this afternoon.